Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Copart Incorporated, ticker CPRT. This company has a market cap of $29 billion and enterprise value of $28 billion. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. Let's dive on in. So again, market cap and EV are very similar. In fact, the market cap is bigger than enterprise value, so we can know that there is some excess cash on this balance sheet. They operate in the commercial services and supplies industry, but we need to see what more that means. So Copart provides online auctions and vehicle remarketing services in the United States, Canada, UK, Brazil, Ireland, Germany, Finland, Arabs, Bahrain, and Spain. So quite a few countries. But I want to say this is, so it's incorporated and based in Dallas, Texas, so presumably a large amount of their business is U.S.-based. Range of services, processing, selling vehicles over the internet, virtual bidding, third-generation internet auction sales system. Let's see, services that comprise services to sell vehicles through crashforcars.com, U-Pull-It service that allows buyers to remove valuable parts and sell remaining parts and body. Sells and provides licensed vehicle dismantlers or builders repair licensors, as well as to the public. So, gives a little bit better understanding. So it's operating in the car industry, online auction, vehicle remarketing, that sort of thing. So I've heard of this company before, but I've never really looked at it. So it's interesting to see now. One of the things that I really love, first look at this, is this return on invested capital chart. So first thing we see is there's 20 straight years of profitability. Great sign of a high quality company. 20 straight years of profitability, 0 losses is a great way to compound your money over time. Next thing we see is that you have this 10% line. That not only do they have no losses, they don't have a single year where the return on invested capital drops below 10%. And for every layer for the last 5 years, it's been over 20%. Now, my threshold that I like to see is 10% and up. But they have averaged 20% return on invested capital over the last 10 years, which is simply amazing. Very high quality company based upon what we see here. Now, they are clearly getting some additional leverage somehow, even despite having extra cash. And so the return on equity is 31%. Really enjoy seeing that. Again, I like to see this number over 10%. I like to see return on invested capital, a return on equity over 15%. The fact that both these numbers are just completely doubling my benchmarks is a very good sign for the quality of this business. Now, where we come next to, though, is, okay, yes, this is a high-quality company, but how is its valuation? And on the first look, the valuation is quite high. Not only is the price to earnings ratio at 27, you also have a high price-to-book ratio of 6.8 and a high price-to-sales ratio of 8.8. So it's not like one of these numbers is out of whack. It's not like the price-to-earnings ratio is high, but it's cheap on book or sales. It is a very high-priced company. Now, very high quality, very high-priced. Now, one thing that's interesting here is we do have revenue growing double digits. That's a very good sign. Revenue growing at basically 12% a year. Now, assets are growing faster than revenue, but earnings per share is outgrowing assets, which is allowing us to still grow our return on invested capital over time, makes it for very attractive returns. Anytime you're growing earnings per share at 20% plus over a 10-year period, you're going to have absolutely amazing returns. It means to get earnings per share down to 10% a year, you're going to have to cut the PE ratio almost in half in order to bring it down, assuming you can maintain that sort of ratio over time. The revenue growing in the double digits, very, very strong. So this is a highly valued company. It is priced as if it's high quality, which it is, but it's also priced to sustain growth like this for a long period of time. If it does grow like this, you still might work out and get a good return, but if the growth drops, you could be in trouble. I mean, I really like to buy companies with a PE of 15. A company of this quality, you might want to, do something like a PE of 20. But either way, as long as the growth is being sustained, you're looking like a really strong future. I don't know how much can be sustained, though. You're going to have a very strong returns for a very long period of time. But what we see here is revenue's basically tripled over the course of a decade. $900 million, $2.6 billion. That's a pretty good growth rate over time. You can see almost every year it's growing, and it's growing almost double digits every year, despite 2015 being a slight decline. That's a very good sign. So it's not like it's just a single year where you're seeing those numbers. You've also tripled your gross profit over time. Your gross profit margin is increasing. That's a very good sign that allows you to get some operating leverage. It's also translating into high operating margins, absolutely ridiculous operating margins. 31% to begin the decade, which would be absolutely amazing. But they end the decade at 42%. 42% operating margins is outstanding in terms of the overall returns you're seeing as a shareholder. And look, this is what that does. Earnings per share going from 70 cents per share to $3.90 per share. So that's over a 5x in the course of a decade. If you can 5x your earnings in a decade, you're going to be very successful as an investor. Just think about what that does. You could 5x your returns in a decade. You're going to be rapidly compounding. A 10% return over the course of a decade is going to mean you're going to double in 7 years. You might be at 2.3x over the course of a decade. This is over twice as high as that. So again, very rapid growth, going to lead to very strong returns. And again, you can also see the operating leverage here. They turn 6% revenue growth, 28% EPS growth. They turn 10% revenue growth, 32% EPS growth, 14% revenue growth, 50% EPS growth. That's operating leverage. That's all how you're really driving those returns. Small changes in revenue is leading to large changes in your operating profit. Very good signs of what I'm seeing here so far in Copart. If you're enjoying this video, please hit that like button. Don't forget to subscribe. Your subscriptions help to drive the growth of my channel. It tells YouTube that you're enjoying the work. Like, subscribe, and you ring that bell so you can get notified as I upload new videos each and every week. Again, we're doing 3 videos a week. Monday, Wednesday, Friday, we're covering S&P 500 companies. We're working through the whole S&P 500. So join us with that. Hit the like button and subscribe. Now, income statement is where we can learn a little bit more about this company. You do see kind of the cost of goods sold growing pretty well, but again, we saw some of that growth in leverage. Now, what's nice here is you've tripled your gross profit, but you've less than doubled your SG&A. Very good sign. That's part of what's driving that operating leverage. You can see tripled gross profit, but you almost 4x your operating profit. You're seeing that gain in extra returns there. The same thing translates to the pre-tax line. You've almost 4x that, 5x pre-tax income, 5x the net income line. Very solid. Now, you do get a boost. Some of this is from the fact that you have lower taxes. Otherwise, that wouldn't be as attractive, so that's hard to repeat. But think about what they're doing here. You also see that despite all this, they've been buying back shares. You started the decade with 263 million shares outstanding. You end at 243. They basically bought back 10% of shares outstanding across the decade. That's adding... it's only a 10% of the shares outstanding, but that's adding about 1% a year to your earnings per share growth. So they're able to have this growth without without having to issue shares. Very solid returns here. Balance sheet. What else can we see here? So you can see the PP&E has increased. They have about 4x the PP&E. So again, your assets are growing quite rapidly. They are growing faster than the revenue. But it's not all PP&E. This is still a relatively small PP&E because if you look at what this number is and just take this number and say your PP&E is $2.4 billion, we can go back to the income statement and your operating profit is $1.3 billion. What's that saying is you're getting like a 50% return on your property, plant, and equipment over those assets. Now, of course, inventories play into this, accounts receivable, it's all part of the business model. But simply on like the PP&E level, it's looking really good. Let's see if I can fix this. Let's go. Okay. So, long-term debt. They have some debt, but again, it's $300 million. They end the decade at $400 million. Your cash has gone up significantly, though. You went from almost, not even $100 million in cash to $1 billion in cash. So you have now net cash. You started the decade with net debt. Very strong returns there. You can see the growth in the equity over time, 7xing over time. Cash flow statement. Let's see. Now, what's interesting here is you are growing your PP&E and you do have some bigger growth here, but you're not growing your depreciation and amortization as much. This could mean that the depreciation and amortization is going to go up over time. With this massive growth in PP&E growth recently, we should expect this number to rise. So you're going to have an effect there. It doesn't matter what that's buying, depending upon how that money is being invested, what that effect's going to be. They do have some stock-based compensation, averaging about $20 million a year, not a super large amount. Also, you can see they're not buying back shares every year. It looks like maybe they're being opportunistic. I like seeing that. But they're also not really paying dividends. So all of the money for shareholders is being returned in a somewhat opportunistic manner for issuance of common stock, but it's really not constant, which means they're retaining all their money in order to drive this revenue growth. They're really investing in organic growth, some acquisitions maybe. Very few acquisitions. It's basically organic growth. So they are having to retain their money, but they're reinvesting at high rates of return, which is why you're seeing those numbers. Now, again, returns, all these number and key ratios are very good. Margins are simply amazing, as I said. You don't see stuff like net margins at 34%. It's just not normal. Pre-tax margin, 41%. Especially the small gap between gross margin of 50% and 41%. Very well operated business here. Let's see, anything else that's useful? Book value growing over time, tangible book value growing over time. You can see the market cap. Look at this. A decade ago, the market cap was $3 billion, and now it's $34 billion. You basically have a 10-bagger in a single decade. Very, very impressive for shareholders. They would have had a very nice return holding Copart. Can they do that again over the next decade? It would be surprising to 10x again because you've already gotten the benefit of multiple expansion, but they've done very, very well here. So for me, Copart absolutely is going on my watch list. I do think the valuation is a little high. I'd like to get it cheaper, but they might be able to justify this valuation. Very high quality business. I'm excited to put it on my watch list and potentially get a stake in a company like this in the future. It's also going to be worth, reading the annual report, learn a little bit more about the business because clearly they are executing to a very high degree. If you enjoyed this video, please hit the like button. Don't forget to subscribe and ring that bell so you can get notified as I upload new videos each and every week. Monday, Wednesday, Friday, we're working through the S&P 500. All 500 companies. We've already done over 100, so be sure to go to the playlist that I have on my channel where I have that backlog of 100 plus S&P 500 companies covered already. This company will be on my watch list. I hope you've enjoyed the video. If you enjoy using this structure that I'm using, this tool that I'm using to evaluate companies, this is what I do to evaluate companies each and every day. I use this tool. This is my live work that I'm doing for my due diligence. I like to do using quickfs.net. If you want to check out quickfs.net and support the channel, then consider using my referral link in the description below. It's the first link there to quickfs.net. If you sign up using my referral link, then I can get a commission for forwarding you to them. But this is the tool I use. I don't recommend anything I don't use. So please check it out if you think this tool would be helpful in your investing endeavors. Thank you for listening. And until next time, stop paying fees, start building wealth.